Steve Jones, you're Chief Investment Officer at Kames Capital here in Edinburgh, Scotland. Now, you manage a range of asset classes from equity, bonds, fixed income, real estate, some more. What's been the most interesting for you in this year or in the past 5 or 6 months?
The year to date has surprised us in the strength of the European equity market rally. We had high hopes for European equities over 2015, but those have materialised far quicker than we would have thought and have been a very strong investment driver for us. The ECB's quantitative easing and some real economic growth and good company results have been driving European equities higher.
How does that translate to your product range?
Well, in our multi-asset funds and in our European equity income activity, then we've been overweight European equities over the likes of the US and other developed markets. And we've not been disappointed in having that position, given the strong performance that's been delivered.
Which company are the most interesting in Europe, speaking of shares?
In terms of individual stocks, then we think the rejuvenation in the banking sector is worth looking at. 7.5 years after the financial crisis, capital and balance sheets have been rebuilt. Companies are beginning to make some money again, and the banks in particular are looking, we think, to distribute that to shareholders through higher dividends. So if you look at the likes of Intesa Sanpaolo, UBS, some of the Northern European names, we would favour those in our portfolio and think that they are worth sponsoring.
Now, there are different countries in Europe and different developments economically. Are there disparities in the European market, in the European equity market from your point of view?
In the world of economic data, then you can definitely point to France as a continued laggard. The most recent news out of the Republic is a bit more positive. And if at last France is beginning to perform alongside Germany and a recovery in Spain and Italy, then actually the future for economics and economic recovery in Europe looks quite good over 2015.
Now, you mentioned the QE of the ECB in Frankfurt. This is, of course, now a driver of the equity markets, but it can also be a risk. So how do you assess the risk of monetary policy taking a different drive, or other risks there are in especially Europe?
We think that QE, where it's been applied in other countries, in the US or in the UK or in more recently Japan, is a strong driver of equity performance. That sort of stimulus of the real economy is effective, and the real only concern is around volatility in the bond market. As you begin to see distortions occur in prices, as you begin to force people into very low or negative yield environments through QE. There will be some pushback from investors to those very poor returns and the volatility that you'll see. These things only enhance the attraction of equities, we think.
How about the US and the Fed? Because they could move on interest rates. It's different from Europe. What's your assessment of the American market?
The US recovery, both in terms of economics and in the market, is far maturer. The US were the first to cleanse their banking system, to implement aggressive QE, to depreciate their currency. And they are the first, therefore, to get the benefit of those actions and have seen a strong and sustained recovery now. Not hugely strong by historic examples, but still positive and consistent over the last 2 years. It's only natural then that the Federal Reserve would want to come off an emergency policy setting and begin the very gentle process of raising interest rates. And we think there's a fair chance that that will happen in September. I think it's very important to say, though, that one interest rate rise does not mean that there is an aggressive cycle of increases to come. The Fed and everything Chairman Yellen has said implies that there is a very gradual pace of normalization to be undergone in the US. And we don't think that that is disruptive to markets. Indeed, it can emphasize the fact that the economy is strong enough to support the little higher cost of money. It can reinforce the equity market rally, and it shouldn't disrupt bond markets that are gently pricing in these things already.
Now we're here in Edinburgh, which is the capital of Scotland, which is still part of the UK, but there's discussion this part of the United Kingdom could split away. The same since the last elections, you've had a discussion on Europe. There was a European referendum. How do you assess this possibility of Britain leaving the UK or the UK splitting up? And what does it mean for this country, but or probably also for Europe?
Well, I think it's worth saying that the issue with regard to Scotland in the United Kingdom has been settled. We had a referendum on that very question, and 55% of those voting, on a very high turnout, wanted to stay within the United Kingdom. So we think that that is put to bed and an issue on the side of things for the time being. The recent overall UK elections has produced a majority Conservative government with a real and concrete commitment to hold a referendum on the United Kingdom's membership of the EU. And this will take place by 2017. And indeed, I think that there is a fair chance that that will happen sooner than perhaps that date implies. As a company doing business in Europe, selling our products in 14 different European jurisdictions, then we want to continue to be part of the EU, and we'll be thinking quite hard about how we campaign to support that view as the debate takes place over the next year, 18 months.